Welcome, ladies and gentlemen. It is Subayal again, and today I would like to talk about a strategy with which you can outperform the market by creating a portfolio solely consisting of different ETFs so that you don't have to waste time in selecting individual stocks. I call this strategy an all ETF portfolio. In this value packed video, I am going to explain number 1, what is this strategy? Why is this strategy beneficial? Number 2, a brief overview of ETFs, meaning what they are. Number 3, difference between ETFs and mutual funds. Number 4, what are the advantages of an all ETF portfolio? Number 5, risks or expenses to be aware of. Number 6, 3 things to look for in an ETF before making it a part of your portfolio. Number 7, how to build a diversified ETF portfolio. And number 8, my thoughts on the strategy. All these sections are time-stamped in the description below. So if you want to skip some parts, feel free to go in the description and click on the parts of the video that you want to watch, which will benefit you the most. But I strongly recommend that you grab a pen or pencil and take notes, since all the sections of this video are very important. Number 1, what is this strategy all about? Why it is beneficial? All ETF portfolio strategy is especially beneficial for those who are new to investing and would like to diversify in the blink of an eye across multiple companies in different geographic regions or sectors. It also gives you the control, since if you want to invest in specific sectors, you can do that by investing in sector-specific ETFs. This will relieve you from the time and energy that you would otherwise spend in shortlisting dozens of individual stocks to invest in. Even though investing in individual stocks can be very attractive and fun, but it requires a strong background in analyzing companies and buying their stocks when they are trading below their intrinsic value. It could get very overwhelming and difficult, so that is where all ETF portfolio strategy comes to our rescue, where we choose a few ETFs that will ultimately form our overall portfolio. Number 2, what are ETFs? Now, just in case if you are new to investing or to this channel, here is a quick overview of what an ETF is. An ETF, or exchange traded fund, is a group or basket of stocks of different companies that are in the same geographic region, country, or in the same sector. Instead of buying individual stocks and making several stock purchases one by one, when you buy ETFs, you buy a selection of many different stocks at once. As I said before, ETFs usually track an index or sector. That is why we have energy specific ETFs, which will track the energy sector, or index funds like the S&P 500, which tracks the 500 biggest companies in the USA. Number 3, difference between ETFs and mutual funds. ETFs are similar to mutual funds, but there are two main differences between ETFs and index funds. The first difference is that in case of mutual funds, the transactions don't occur until the market closes, while in case of ETFs, they can be bought or sold during the trading day, just like stocks. The second difference is that mutual funds are actively managed by a fund manager who must be paid. Most ETFs, on the other hand, are passively managed, and therefore the fee is much lower. It means that in most cases, the expense ratio of ETFs is way lower than the mutual funds. If you want to learn more about the differences between mutual funds, index funds, and ETFs, I have provided a link to the video explaining the differences between them in detail in the description down below. Number 4, what are the advantages of an all ETF portfolio? Now the question is, should you have an all ETF portfolio or not? So first of all, an all ETF portfolio gives you the ability of instant diversification across various companies in an industrial sector, or let's say companies in a geographic region or country shortlisted by a certain criteria. It saves you a ton of time, since you don't have to do the due diligence of individual companies, go through their financial statements, read their quarterly reports, and compute the intrinsic value of their stocks and so on. Moreover, it gives you the ability to leverage the macro trends in the economies across the globe. With an all ETF portfolio, you can leverage both the macro trends as well as the economies of certain countries which you think are going to create enormous impact globally. For example, if you think that the American economy will do better in coming decades, you can invest in an ETF that tracks the S&P 500. Now, S&P 500 is an index fund that tracks the 500 biggest companies in the USA FAA. We also have many ETFs which track the FTSE 100, which is a share index of the 100 companies listed on the London Stock Exchange with the highest market capitalization. Moreover, you can pick up a macro trend with ETFs. Such ETFs comprise of companies that want to ride the trends via radical innovations. These companies might create enormous value in different industrial segments or business ecosystems. ARK Invest, led by Cathy Woods, has several such ETFs, as we will discuss later. Moreover, ARK is not the only company that offers such ETFs. There are many different options to choose from. Number 5. Risks or expenses to be aware of. Number 1. Is the fee worth it? So of course we have to pay a small amount of fee when we purchase ETFs, even though this fee is small. It is mostly under 1% and is deducted from the value of your ETF's allocation. Now, since the fees compound over time, the longer the investing period, the bigger the loss you will incur from fees. Of course, we can go and buy individual stocks in ETFs, but it is not as easy as it seems, since for example in the case of S&P 500, it would be very difficult to replicate the fund by buying individual stocks in the index. The reason is that various stocks in the S&P 500 index have different weighting and it changes with time. So it is going to be very difficult for you to keep on adjusting the weighting of companies with time, as happens in the case of S&P 500. An ETF tracking the S&P 500 index will track the index precisely, so you don't have to. It will save you a lot of time that you would spend otherwise to maintain the same weightings. I personally think the small fee is worth it. Number 2, lower dividend yield. So there are a number of dividend paying ETFs, however the dividend yields that are offered by them are not as high as simply owning a group of individual dividend paying stocks. The reason is that an ETF mostly don't contain just dividend paying stocks, and some of the stocks in that ETF could potentially be non-dividend paying. Also, in addition to that, the expense ratio which is charged for owning an ETF also reduces the real dividend yield of an ETF. Number 3, leveraged ETFs. The last caution I would like to tell you is about the temptation of investing in leveraged ETFs. In fact, the leveraged ETFs use the complicated financial derivatives and debt in order to return 2x or 3x return that you would typically get with a standard ETF. So for example, if you had bought a 2x leveraged ETF on the S&P 500, in that case, if the S&P 500 moves 2%, the leveraged ETF position will move 4% respectively. One example of leveraged ETF is FAS. This ETF aims to provide investors 3x the return for the financial stocks it tracks. This ETF holds equities of large US financial companies by tracking the Russell 1000 Financial Services Index. FAS has an expense ratio of 0.99% and top holdings includes Berkshire Hathaway, Visa and JP Morgan Chase. For example, if an investor invested $10,000 in the ETF and the stocks tracked from the index rose by 1%, the ETF would return 3% in that period. However, if the underlying index declined by 2%, the FAS would have a loss of 6% for that period. As I stated earlier, leveraged ETFs are used for short-term moves in the market and can result in large gains or losses very quickly for investors. Personally, I am not a fan of leveraged ETFs and would recommend staying away from them, especially if you are investing for the long term and you don't understand them. So now that we have gone over some of the general risks and misunderstandings with ETFs, let's talk about how to choose ETFs for our All ETF portfolio. 3 things to look for in an ETF before making it a part of our All ETF portfolio. There are 3 things that I always look for before investing in an ETF. The first one is the expense ratio. So please make sure that the expense ratio is not very high as compared with other ETFs that track the same index or the same or similar sectors. Number 2, assets under management. It is important to look for an ETF that has higher number of assets under management relative to other ETFs that track the same index or stocks in the similar sector. Liquidity is super important since you have to make sure that you can buy and sell ETFs quickly whenever you want. Number 3, stocks contained in an ETF and the weighting. Lastly, the third thing I look at is which stocks are contained in the ETF. Ideally, we don't want the top 10 holdings of an ETF to be an oversized portion of the overall ETF. Number 7, how to build a diversified ETF portfolio. 2 sites that I believe are great for doing research on ETFs are etfdb.com and etf.com. These sites will help you tremendously when you are building your all ETF portfolio. Here are two most important points you should remember while building your all ETF portfolio. Number one, broad diversification. Broad diversification should be your main goal, and the easiest way to achieve this is through an ETF which tracks the S&P 500 or any other index such as the FTSE 100 index, which consists of top 100 companies of UK by market capitalization. You can have 1, 2 or 3 such ETFs that will make up for about 50% or 60% of your overall all ETF portfolio. There are plenty of options out there for such ETFs, and you can find them on the Vanguard website. I will leave a link to the Vanguard website in the description below. Number two, leverage the macro trends or sector growth. The main goal of this part of the portfolio is to leverage the macro trends with an intent to outperform the market. If the trend doesn't pan out like you would have hoped, at least you can sleep well, since most or half of your portfolio is still giving you the returns of the overall market. Investing in these ETFs is riskier as compared to the ETFs in the first pool that comprises solely of ETFs that give you a very broad diversification. This second pool of ETFs does come with more risk because the performance of ETFs over here will depend on the macro trends or sector. You can balance that risk with the time horizon of your investing. So the longer the duration for which you are investing, the less risky it would be, since the price drops due to short-term volatility will be mitigated by the long-term trend and adoption of the technologies, or let's say the growth of the sector which is targeted by that ETF. Let's get into some macro trend examples now. Here are a few potential themes or trends that you could look at. These are not my recommendations, these are just examples. These are the themes around which the ARK ETFs are created. Cathie Wood has been a lot in the news since her ETFs outperformed the market during the coronavirus pandemic, but now the trend has changed and most of her ETFs have significantly dropped in price. So as I mentioned before, they are riskier. Now ARK Invest is not the only company that offers ETFs which are centered on the idea of sector growth, or let's say that track the performance of companies that are developing cutting-edge technologies in different trends that could potentially impact various business ecosystems in future. Here are some of the main ARK ETFs. Once again, and their names show the trends or sectors of companies which they cover. You can read more about them on the ARK Invest website. And now my thoughts on the strategy. In short, ETFs give you the exposure to companies in different sectors, trends or indexes with the click of a button. In the same way as the ticker symbol of a company gives you the ability to invest in its stock. An ETF on the other hand gives you the ability to invest in many companies simultaneously with the click of a button. Before selecting an ETF for your all ETF portfolio, always ask yourself, what is your risk tolerance? For how long do you want to invest? And most of all, would you potentially need the money in coming 2 or 3 years? The last question is very important, since the last thing you want to do is to sell your ETFs just because you need the money for buying a house or something else. This will make your paper losses real. So only invest what you can afford to lose and invest in long term. Also ask yourself which sector specific ETFs will suit your investment goals. Everyone has different level of risk tolerance and investment time horizon. You know your financial goals and situation best, and I am personally not invested in the ARK ETFs. This was just an example, as I told you, to help you in understanding the strategy. If you don't feel like investing only in ETFs, you don't have to try this strategy. The aim of this video was to give you a solid overview of this strategy, and I hope that you gained a new perspective on investing by watching this video and got some valuable insights. If you want to know more about the differences between ETFs, mutual funds and index funds, please watch the video, the link of which is down in the description. And also make sure to subscribe to the channel, and I will see you guys in the next video. Bye for now.